Founded in America, BlackRock set its gaze across the ocean, toward Europe. The first steps of a transcontinental empire were taken quietly, through strategic moves. Yet Europe's entrenched financial systems, complex regulations, and diverse political climates would prove to be not just a market for BlackRock, but a colossal barrier to overcome. In this section, we'll examine how BlackRock penetrated Europe, how it turned the continent's economic crises into opportunities, and how it became the EU's largest fund manager. Yet this expansion would bring serious criticisms, investigations, and political storms in its wake. Could Europe resist BlackRock's growing power? Or would this giant completely reshape the continent's financial destiny? BlackRock's European venture began with a strategy distinct from its American ascent. Here, rather than making a fresh start, growth through existing structures and strategic acquisitions took center stage. BlackRock's first European footprint was established in 1995, before becoming an independent company, through the opening of London and Frankfurt offices under its U.S. parent shareholder, PNC Financial Services. These were not pioneering moves so much as cautious steps to take the continent's pulse, understand the market, and identify potential opportunities. That same year, BlackRock launched its first European product, a €1.2 billion European corporate bond fund. This fund marked the first signal that the company was bringing its fixed income asset expertise to the European market. 4 years later, in 1999, BlackRock's pivotal moment arrived. After fully separating from Blackstone, BlackRock Europe Ltd was incorporated in the United Kingdom. Now operating as an independent entity, the firm could play a far more active role in European markets. This independence brought its first major product, a UK equity passive fund. This served as tangible proof that the company was transplanting its signature passive investment strategies, the very foundation of its US success, into European soil. However, BlackRock's true metamorphosis into a European giant came with its 2006 merger with Merrill Lynch Investment Managers, a deal that was less a merger and more a full-scale conquest. MLIM's colossal €120 billion European ETF portfolio was absorbed into BlackRock, instantly catapulting the firm into becoming one of Europe's largest ETF players overnight. Strategic products like the iShares MSCI Europe and Euro Stoxx X50 ETFs became the crown jewels, solidifying BlackRock's market dominance. Now, BlackRock had its fingerprints on portfolios of both retail and institutional investors across every corner of Europe. In 2009, amid the lingering shadow of the global financial crisis, BlackRock took center stage at Davos to unveil its European ESG strategy, not merely capitalizing on an investment trend, but asserting its ambition to reshape the future of finance. That same year, it listed the iShares MSCI Europe ESG screened ETF on Amsterdam's exchange, marking a pivotal step toward becoming a standard bearer for sustainable investing. This became the first tangible manifestation of the firm's investment risk is climate risk philosophy in Europe. In 2014, BlackRock cemented its presence in Germany by establishing Frankfurt as its central hub. The creation of BlackRock Deutschland AG and the acquisition of a BaFin license allowed the firm to deepen its operations in Europe's largest economy. Notably, relocating its iShares Euro government bond ETFs to Frankfurt strengthened its influence over the Eurozone's sovereign debt markets. 2018 was a year when winds of transparency blew through European financial markets, with major EU regulations like MiFID II coming into force. BlackRock adapted to this change by implementing ESMA's MiFID II compliant transparent fee model. Simultaneously, it opened its Paris office and updated its iShares Euro corporate bond series, thereby increasing its influence in the French market. While complying with the EU's regulatory framework, BlackRock was also consolidating its own market power. Every crisis opened a window of opportunity for BlackRock. In 2020, when the COVID-19 pandemic hit the European economy, BlackRock stepped into the spotlight once again. The European Central Bank employed BlackRock's Aladdin platform to manage its €15 billion corporate bond purchase program aimed at supporting the economy. Its crisis management experience from the US now manifested in Europe. Once more, BlackRock emerged stronger from the crisis, becoming an indispensable partner even during the financial system's darkest hours. By 2022, net zero targets had become Europe's new economic agenda. True to form, BlackRock positioned itself at the forefront of this transformation. The launch of its Paris-based Net Zero Europe ETF reaffirmed its commitment to sustainable finance. More significantly, by securing management of 3.1 billion euros in European Green Deal funds, the firm became directly integrated with the continent's sustainability objectives. This move represented more than just marketing. It signaled BlackRock's strategic investment in Europe's future growth sectors. And 2025, as crypto assets became the new darling of the financial world, BlackRock once again positioned itself at the forefront. Its iShares Bitcoin ETP began trading on the Paris, Amsterdam, and Frankfurt stock exchanges. Clear proof of the firm's innovation and market adaptability. Yet this move also reflected Europe's regulatory complexities and the inherent risks of crypto assets. That same year, as geopolitical risks escalated, BlackRock also made its move into Europe's defense industry. Partnering with BNP Paribas, it launched European defense ETFs, commencing management of 2.7 billion euros in assets. This demonstrated how the firm could wield influence not just in environmental and social spheres, but equally in strategic and defense domains. As of 2025, BlackRock has grown into a European powerhouse with 4,070 employees across 12 offices. London serves as its EMEA headquarters with 1,100 staff, while Frankfurt, home to 900 employees, operates as the ETF listing hub. Paris has become the nerve center for net zero and climate ETFs with 750 personnel. Amsterdam plays a strategic role as the Aladdin platform's EMEA data center, and Zurich manages crypto and private banking operations. Meanwhile, Milan and Madrid anchor the firm's retail distribution networks in Italy and Spain, respectively. The numbers reveal BlackRock's formidable presence in Europe in concrete terms. The company's total European ETF assets under management have surpassed 1.2 trillion euros, representing approximately 42% of its US ETF assets. In 2024 alone, BlackRock's ETF trading volume in Europe reached 420 billion euros. In the sustainable investment sector, it manages 480 billion euros in ESG-focused assets, constituting 40% of its total managed assets in Europe. The company offers a comprehensive product portfolio including iShares ETFs, active equity, and fixed income funds, as well as private asset and infrastructure funds. Notably, funds like the iShares MSCI Europe ESG Screened and iShares StoxX Europe 600 Information Technology reinforce its market leadership position. BlackRock's largest clients in Europe include institutional giants such as Norway's Government Pension Fund, Dutch Pension Fund, APG, and Sweden's Alecta. These clients demonstrate that BlackRock is not just an asset manager, but also a strategic partner shaping Europe's financial future. In Europe, BlackRock is not just a major player, but also under constant regulatory scrutiny. The continent's complex bureaucratic framework prolongs the company's product approval processes and increases compliance costs. Particularly, MiCA and new ESG reporting standards are making it more challenging for BlackRock to launch innovative products. While spot Bitcoin ETFs receive swift approval in the US, the situation is markedly different in Europe. This transatlantic regulatory divergence creates significant operational challenges for BlackRock's global strategies. Europe's more cautious approach substantially slows the market integration of innovative financial products. Europe stands at the epicenter of geopolitical risks. US tariffs, energy price shocks, and China's economic slowdown are severely pressuring European corporate profitability. This situation is reducing inflows into BlackRock's European equity and bond funds. Middle East tensions and the Russia-Ukraine war continue to keep energy costs volatile, further negatively impacting fund returns. ESG represents one of BlackRock's greatest contradictions in Europe. While claiming leadership in net zero commitments, its continued fossil fuel investments spark accusations of greenwashing. Under the Paris Agreement and SFDR regulations, funds are now required to transition to emissions reporting. If companies fail to provide science-based targets, BlackRock could face potential fund exclusions. Despite Larry Fink's declaration since 2020 that climate risk is investment risk, the company has continued investing $259 billion globally in fossil fuels during this same period. According to reports from over 25 NGOs, BlackRock remains the largest institutional investor in coal with $109 billion in holdings. This contradiction faces ongoing criticism from the European Parliament and environmental ministries. NGOs like Client Earth filed complaints with the AMF, alleging that 18 UK funds labeled as sustainable held over $1 billion in fossil fuel investments. As a result, 14 funds removed their sustainable designation, while 3 funds added new fossil fuel filters. Notably, Larry Fink's 2024 shareholder letter conspicuously omitted any mention of ESG while emphasizing energy pragmatism, sparking fresh scrutiny of the company's stance on this issue. BlackRock faces voting challenges at certain shareholder meetings due to share blocking and local proxy complications, potentially impacting investor satisfaction. Regulators including BaFin, AMF, and FCA have warned the company about voting costs and logistical hurdles. In a June 2023 scandal, it was revealed that some BlackRock funds hadn't voted on US stocks for a decade, including UK pension plans. This exposed deficiencies in Britain's implementation statement regulation, which mandates voting activity reporting. BlackRock's iShares ETFs, commanding a dominant 43% market share in Europe, has drawn scrutiny from competition authorities. Institutions like the ECB and AMF could potentially launch market dominance investigations. In Germany particularly, iShares ETFs' over 40% market penetration has attracted attention from regulators including Bundeskartellamt and BaFin. However, as of 2025, no formal antitrust case or sanctions have been filed against BlackRock in Germany. In a European market hosting over 160 crypto products, even major players like BlackRock face challenges in differentiating themselves with innovative offerings. The total crypto market size remains significantly smaller than the US at just 17.3 billion euros, creating scalability barriers for new products. BlackRock has also made headlines for its lobbying against EU regulations. The company actively lobbied in Brussels to exempt the financial sector from the draft EU Corporate Responsibility Directive. A leaked memo revealed it specifically sought exemptions for indirect emissions. While the European Parliament's 2023 text included financial institutions, France and industry representatives pushed back against these provisions. BlackRock's rise in Germany hasn't been without controversy. In 2015, BaFin imposed a €3.25 million fine on BlackRock Investment Management Limited for incorrectly or belatedly reporting ownership data in 48 major German companies including Deutsche Bank, Allianz, and Siemens. This constituted a financial reporting violation rather than an antitrust breach. Moreover, BlackRock's ownership of 10.4% of the free float shares in DAX companies and its commanding greater than 40% share of the German ETF market continues fueling market dominance debates. In France, BlackRock became a target of pension reform protests. In 2023, railway workers occupied its Paris office. Activists were demonstrating against both Macron's pension reforms and BlackRock's role in private pension funds. Meanwhile, Client Earth's complaint about fossil fuel investments in sustainable funds is under investigation by the AMF. Despite all these criticisms and challenges in Europe, BlackRock maintains a robust defense strategy. The company consistently emphasizes that its core mission remains anchored in transparency, adherence to corporate governance principles, and safeguarding its clients' long-term interests. The company emphasizes its proactive compliance with MiFID II and other EU regulations, highlighting its leadership in implementing industry-first practices like transparent fee models. It notes that regulatory penalties typically relate to specific historical issues, such as past reporting discrepancies. BlackRock's European journey weaves a complex tale where power, markets, and politics intertwine. It has become both an indispensable partner during Europe's economic crises and a colossal asset manager facing fierce criticism from politicians, NGOs, and the public alike. BlackRock, which manages over 1/10 of UK pension funds, 10% of DAX companies in Germany, more than 40% of the ETF market in Germany, and 43% of France's ETF market, has effectively become the backbone of Europe's financial system. These figures and BlackRock's pan-European presence demonstrate that it has evolved beyond being merely an investment firm into a power center capable of influencing Europe's economic, and even political destiny. But how will BlackRock's influence shape Europe's future independence and political sovereignty? This question will remain one of the most critical issues the continent must grapple with in the coming years. BlackRock's global footprint extends far beyond Europe. In the next chapter, we'll examine the firm's expansion across Asia-Pacific, its complex relationship with China, and its evolving role in shaping the future of global finance. Subscribe, leave a comment, and don't forget to turn on notifications to stay updated about new episodes.